It's your boy Tyler coming at you guys live with another video here on this Sunday afternoon, and this week is going to be crazy, so I hope you guys are jacked up, jacked to the tits, ready to go and talk about it, because here this week we actually had a very big rally on the S&P 500 last week on Friday. That was due to the Fed. But the main story of this week will still be the Fed, no shocker there. It will be the dollar, if we can actually get a break, if this thing can come down just a little bit, and what's going to happen with bond yields, what's going to happen, like I said, with earnings, with the Fed. We're going to talk about all of that. AMC also, well, not specifically AMC, but the theater industry had very, very positive news as well. So let's talk about all of this. Are we going to get a bear market bounce? Is it going to start this week? What could you expect? How's the best way to trade this, in my personal opinion? Well, let's get into that and much more here in this video. So, I hope you guys are ready to get into this video. Hit that like button and subscribe to the channel if you guys have not already. And if you want to trade with me live in real time, link down below in the description of this video. Earnings season is the most exciting season to be a part of that community. Let's get into it, guys. So on Friday, the whole reason why the markets rallied was really due to the Fed, and specifically Fed Daly and Fed Bullard. They had came out and said that the Fed should do a 75 basis point rate hike in November and then pause and assess the situation, or go down to a smaller rate hike, a 50 or 25 basis point rate hike. That was very bullish. You also had a Wall Street Journal article that came out and said a lot of Fed members, not just Fed Daly, Fed Bullard, are talking about doing a smaller rate hike after November, which the markets still, as of right now, were pricing in a 65% chance of a 75 basis point rate hike in December. So by and large, it was not priced in to get a smaller rate hike in December. So that would be seen as a Fed pivot, and that would cause this bear market bounce. But we're not quite there as of right now. We still have to watch the futures market, the swaps, to see if the markets do start to fully price that in and what happens throughout this week. I don't believe we have too many Fed speakers, but we're going to go over that data. So that's what really caused this market rally on Friday. The biggest things that are really holding this rally back is by far the dollar and bond yield. So TLT, this is the 20-year treasury. This thing is completely collapsing. The Fed is breaking the bond market, and I hope you guys watched that video that I put out. You've never seen a drop in the bonds this aggressively ever in the history of the bonds. When this falls, that means yields are going up. So yields are shooting through the roof as of right now. If we go ahead and pull up the bond yields on a 10-year bond, you're sitting at 4.22%. 4.219%. For an example here, guys, the markets, they freaked out back here in June. That's why you hit the low in June. Remember that? When bond yields climbed from 2.74% to 3.48% in the course of about 2 weeks. This was what freaked the markets out and gave us that first initial low for the stock market, almost exactly coinciding with the low of the market. Yields did start to tumble over as people started to expect the peak of inflation was here, and bond yields went all the way back down to 2.64%. You're almost double that now. You've literally been going straight up, and it's no surprise why the markets are sitting at the levels they're sitting at, given what has happened with the bond yield. So if we can get the markets to price in not a 75 basis point rate hike for December, maybe a 50 basis point, maybe a 25 basis point, and then stopping and assessing the situation, that's going to be very, very bullish for the stock market. And if you do see those yields you roll over and come down, like I said, that will help give you that bear market bounce. So that is the biggest thing that is really a weighing factor on this market as of right now. And it's also the dollar, because the dollar has also never been this strong. If you pull up a monthly chart, it's clear to see the dollar's never been this high before, and that's bad fundamentally for businesses. So, and that's the main reason why Tesla actually missed their revenue numbers, because 50% of Tesla's business is done in foreign currencies. When they take in those those weak foreign currencies and trade it in for a strong US dollar, they're getting a lot less dollars for those weaker global market currencies. So that's why fundamentally it's a really, really bad thing. And that's why literally, I mean, look at the chart. Since this was the COVID crash, what happened with COVID, the dollar did nothing but go down and the stock market did nothing but go up. Ever since the dollar started to really bottom out and, you know, the dollar started to make its way higher around June 2021, a lot of stocks peaked out around that time. The broad markets peaked out around November, at least for the NASDAQ. And what's happened with this chart? It's literally been going straight up gradually over time, right, over the last year and a half, and the stock market has literally been going down. They're polar opposites of each other. So if we can get the dollar to really take a break and come down in a big way in this week, and you do see bond yields come down as well, that will give us the bear market rally in and of itself, given how far the dollar has ran, how overbought it is, and how oversold the bond market is, how high bond yields are in a very short amount of time. So hopefully that makes some sense to you guys. Hopefully that put it into context a little bit about what happened on Friday. But you have this week, you have earnings, and that's going to be the real wild card here, because on Tuesday you're going to kick off with UPS, GM, Coca-Cola, Cliffs, Halliburton, GE, 3M, JetBlue, Raytheon Technologies that report earnings in pre-market. And then Tuesday you have the big dogs that report: Microsoft, Apple, Microsoft, Alphabet, Enphase, Visa, Chipotle, Spotify, Texas Instruments, Skechers, Boyd, and F5 that report earnings Tuesday and after hours. That's going to be the big day. That's going to be the start of really the large tech earnings. And these companies, I say that because Microsoft controls over 5% of the NASDAQ itself. Alphabet is close right there as well, around 4.5–5%. So that's 10% of the NASDAQ that will be reporting earnings. If they fall 10%, that's an automatic 1% down move for the NASDAQ at the very minimum, let alone some of the sympathy moves and fear that these earnings could cause. Now, I don't know exactly what's going to happen. It seems like earnings have been pretty decent as of right now. So it's really a 50-50 kind of situation. So I think if it is a 50-50 kind of situation, there's good and bad out of all these companies. If they all don't just completely slaughter their earnings, or if they all don't have great earnings, it's really going to come down to the Fed, the bonds, and the dollar. But like I said, if earnings are great, you're off to the races. If earnings are bad, well, we need the dollar to come down and we need bond yields to come down, or if they don't, then you're screwed, basically is what I'm saying. Wednesday in pre-market, you have Boeing, Waste Management, Bristol, Squibb, Myers, Kraft Heinz, Hilton's, Thermo Fisher, Harley Davidson. And then Wednesday after hours, you have Meta, Facebook, Ford, Teladoc, ServiceNow, and Analyze, O'Reilly Auto Parts, some names the markets aren't going to care about too much. Thursday, pre-market, Shopify, McDonald's, Caterpillar, Southwest Airlines, MasterCard, Merck, Altria, Comcast, and Credit Suisse. That one might be quite interesting for the markets, given what has been happening with Credit Suisse. And then Thursday and after hours, this is the big day, guys. Tuesday and Thursday, these are the days that will really dictate the likelihood of a bear market rally, or, you know, potentially hitting those new lows. It's going to be Apple in after hours on Thursday, Amazon, Intel, Pinterest, Southwestern Energy, Gilly, but really, as you guys can tell, Apple and Amazon, those are going to be the main ones for this earnings season, and they always are. Microsoft, Google, Apple, Amazon. Those are really the four that are the big deal that you need to see do okay. If these guys were to get slashed, any one of them, you know, 15–20%, well, there could be pain ahead for the market. So there is all of that. Those are the earnings. Like I said, a lot of this bear market rally might depend on the bonds and the dollar. But as far as economic data, as far as Fed speakers, let's take a look at it. It looks like Monday, all you have is bond auctions coming out at about 11:30 a.m. That can actually move the markets because the bond auctions dictate the bond yield. So if bond yields do shoot down, that would be a very good thing, right? That would be very positive if people go out and buy bonds at these levels. So we'll see what happens with that one. On Tuesday, you really don't have too much. You have the Richmond Fed, S&P, Case, Shiller, home price, month over month and year over year. The Red Book year over year for October 22nd. None of these are expected to be major data points by any means. And then on Wednesday, you don't have too much besides the Bank of Canada interest rate decision, Bank of Canada monetary policy report, and new home sales. All of that comes out at 10 a.m. on Wednesday. That's probably going to be the major data point that we do get for this week. You have retail inventories excluding autos month over month for September as well. Good trades balance, building permits, some things that are really secondary data points, but nonetheless could be important given how our markets react to things. You know, this day and age. On Thursday, you do have, let's go ahead and take a look at it. Durable goods orders month over month for September at 8:30 in the morning. GDP growth rate quarter over quarter. Advanced data for Q3. And GDP price index quarter over quarter advance for Q3 as well. So you got growth rate and price index and durable goods orders, all of that coming out at 8:30 in the morning. It's pretty clear that we already had negative GDP. I don't think it's going to be revised too much, so I don't think this will actually be a big data point. But durable goods orders, that will be more important in my personal opinion. Nonetheless, you have some ECB speakers as well on Thursday at 10:15 a.m. and 10:30 a.m. as well, so that will be important. More bond auctions on Thursday as well, around 11. Usually they're about 11:12 in the morning. And that's basically it. On Friday, you really don't have too much. Personal income month over month for September, personal spending month over month for September as well. Those might be important, but then again, you know, people really care about you know, inflation, the Fed, what's going to happen with bonds. So I don't know how important personal spending will actually be. But you do have core PC price index month over month for September, and year over year for September as well. That's the metric that the Fed really likes to pay close attention to. So if the PCE index does come down, that will be very bullish, and that might solidify to the bond markets that we will get an easing of these gigantic rate hikes. Nonetheless, let's talk about what came out this weekend that is potentially very bullish for AMC stock for the theater industry overall. And we're going to be quick about this. It says Black Adam tally 67 million in domestic debut. First film opening since July to top 50 million. And is basically the one with The Rock. So we'll see how that does. It might give the theaters in the morning a little bit of a boost. Nonetheless, as far as the S&P 500 and the option activity that we are currently seeing, you only have 23.73% of the open interest weighted to the call side. So if you do get a big move up, you know, in the beginning of the week or really whenever it is, you're probably going to see a lot of shorts get out of those short positions in a very quick fashion, because there's so little exposure to the long side, and hedge funds really don't have exposure in general to the long side. This is the lowest net long positioning hedge funds have had in the history of forever, so they're not really in a good position to capitalize on an upward move in the stock market. In other words, they're going to make a lot more money if the stock market continues to come down. And as far as the interesting flow sentiment, on Friday, you've seen about 7,700 orders totaling $728 million, positive order value of 83%. So that is a bullish figure in my personal opinion. Typically, in this day and age, you're not really seeing positive order value, you know, that high. So when it is that high and you have a lot of very bullish positioning, that is at least showing me that the potential for a bear market bounce is really there, and some hedge funds are starting to bet along those same lines. Now, as far as the option activity for AMC on Friday, you only had about $450,000 worth of interesting options, but you did have a positive order value of 57%. So that is bullish given it's over 50%. Now, the live short interest we are looking at, it says 18.48%, but the daily short interest says we're at 19.26%. So take it for what it is. Who knows exactly what the number is? I think it's clear it's a lot higher than what we are being showed it is. Free flow out on loan at about 36%. Shares out on loan 187 million. Days to cover 4.84, getting ever so closer to that 5-day level. Cost to borrow at 19.41% and 100% share utilization. Cost to borrow max sitting at 23%, cost to borrow minimum at 19%, and cost to borrow average at 20%. These numbers are still well higher than the average cost to borrow rates on the markets. We're not even in the same ballpark as far as that is concerned. So guys, the biggest things to really watch: the bond yields, the dollar, and earnings. The dollar needs to come down, and the way you guys can chart that and watch that is UUP. This is the dollar index, and if this comes down like we seen on Friday, it was down 0.86%. that is a very bullish thing for the markets. And I don't know why the light went out. We're almost done with this video, so I'm not gonna stop to turn it on. We're just gonna keep going with it. But if this comes down, that's going to be a very good thing at any point this week. And if the bond yields also come down, that will be good, and you can monitor that by looking at TLT. If TLT goes up, that is a very bullish thing for the market. So that's going to be all for this video. Really, thank you guys for watching. As far as technicals on the S&P 500, you know, you're sitting at a very interesting level. If we can break out above that 375 level with good momentum, then it looks like the next major levels of resistance might be at the 50 and 100-day moving averages around that 390 level, that 387 level, and that would be a very welcome sign. As of right now, I think as high as you could possibly go would probably be about 409 with this bear market rally. Potentially could go higher, but 409 would be a very healthy bear market bounce. Even, you know, in between 400 and 409, that would really be my price target if earnings are great this week and you do get that ultimate Fed pivot, and the markets do really start to expect that, guys. So that is going to be all for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you for watching, and I will see you in the next one.